Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. Last week we highlighted that our investor diversity indicator are flagging a high risk of reversal in different equity markets. This week, the US equity rally stalled after hitting record highs, and government bond yields slumped. While we remain overweight equities, we have trimmed excessive exposure to equities to add to DM government bonds. To dissect this, I've invited Rajat Bhattacharya, our senior investment strategist here at our Chief Investment Office. Welcome, Rajat. Can you just bring our listeners through the thought process around trimming the equity risk and adding to bonds?
Hi, John. Glad to be here. Yes, indeed, like you said, last week, our investor diversity indicators were signaling a high risk of a reversal in global equities, US equities, European equities, as well as developed market high yield bonds. This week, the US equity rally stalled after hitting record highs and government bond yields slumped. In other words, bonds surged. The catalysts were few. The first one, Fed pushing back against expectations of a March rate cut. Second, renewed concerns about US small banks' exposure to commercial property sector. And third, disappointing revenue guidance from some technology sector leaders. Now, given this, we maintain our overweight stance on equities, including US equities, but we have opted to trim is the key word here, our excessive exposure as a result of the rally since we published our Outlook 2024 report in mid December to bring those allocations back closer to our target foundation allocations. We continue to be overweight on global and US equities, though to a lesser extent than we were in December. Concurrently, we have redirected proceeds from trimming equities to fund our allocations to the developed market government bonds, which includes US government bonds, which continue to offer attractive yields. The US benchmark 10-year government bond yield fell almost 24 basis points this week and bottomed at around 3.8%. Now, in addition to policy pivot expectations that I mentioned before, mixed job data and escalating concerns over the small banks' exposure to the commercial real estate sector have contributed to rush for safe havens, although we believe there are some idiosyncratic risks there. Technical indicators suggest the 10-year US government bond yield has a support around 3.78%, and resistance is now moved lower to around 3.92%. So we will use any rebound in government bond yields to add exposure while we remain overweight in the US government bond sector.
A couple of marquee events this week, and I think you alluded to one as well, Rajat. So, what were the key takeaways from them?
So the main one, of course, was the Fed's first policy meeting of the year. Now, the message from the Fed was very clear. While policymakers see the ongoing disinflation process conducive to initiating rate cuts later this year, they would prefer further data confirmation before acting. So they believe that we're not still there yet. So we continue to expect the first 25 basis points rate cut in May or in June, followed by another 100 basis points of cuts in the second half of this year. This is, of course, contingent upon signs of significant growth slowdown and confirmation of inflation approaching the Fed's 2% target by the second quarter. The other main event of the week was, of course, the US technology sector earnings for Q4 2023. This was a crucial week for earnings given that five of the so called Magnificent Seven mega cap companies in the technology sector, mainly in the technology sector, which have been driving the US earnings and stock performance over the past year, were due to report this week. The earnings turned out to be a mixed bag, I must say. While Alphabet and Apple disappointed with their revenue guidance, Microsoft met expectations, and Amazon and Meta gave strong guidance. Overall, almost 40%, more just over 40% of the S&P 500 companies have released Q4 earnings as of 1st February. While earnings surprised on the upside by 6%, 2024 earnings growth estimates have fallen to around 10% from an estimated 11% since the start of the year. Now, lingering concerns of a higher for longer interest rate regime and elevated inflation levels have weighed on earnings guidance so far.
So given this, do you expect the rally in growth stocks to continue?
Yes, overall, we expect growth stocks to continue contributing strongly to earnings growth in the US in 2024. Having said that, we acknowledge near term weakness in the electric vehicle segment. While secular demand is positive there, intensifying competition may hinder sales and earnings growth. The potential of geopolitical tensions, especially ahead of US elections this year, may also impact supply chain of the major electric vehicle companies should there be any major trade restrictions this year. So in turn, we suggest switching into growth stocks which have stronger recurring revenue streams and are better able to weather unfavorable macroeconomic environment. For instance, software as a service and solutions companies tend to have greater resilience against cyclical downturns. Drivers such as cloud transition and rising artificial intelligence adoption are supportive to their outlook.
Moving on to the peers of US equity, Europe equities, we saw a multi-year high for Europe equities this week. What's next from here?
So you're right that the Euro Stox 50 index, for instance, rose to a 23-year high this week, while the broader MSCI Europe is a whisker below the January 2022 high. Now, this strong performance was led by technology, industrials, and healthcare sectors over the past year. Now, semiconductors, which account for over half the technology sector in Europe, has been benefiting from the artificial intelligence investments and unprecedented equipment demand from China. The software industry is also benefiting from a successful transition to cloud. The industrial sector, meanwhile, has done well as Europe's economic environment has been better than expected. As we know, that Europe escaped a recession in the fourth quarter of last year, having managed to just stay flat. The grow, was unchanged. Growth was unchanged in the final quarter. Now, the latest euro area unemployment data is shows record low unemployment, while the GDP was better than feared, as I mentioned. Meanwhile, the healthcare sector has performed well on better valuation, with more optimism on the drugs pipeline on top of steady earnings growth. So, all in all, MSCI Europe Index continues to be attractively valued at around 13 times 12-month forward PE, which is a 22% discount to global equities, and which is also wider than the historical 10% average discount for the market. In the near term, we see European equities as overbought with risk of a minor pullback, with support for the Eurostox 50 at around 4,400. We believe it will be attractive to add exposure to the technology and healthcare sectors in a pullback. We call this the barbell strategy that would benefit from the technology sector's growth and healthcare sector's defensiveness.
Well, before we end off, Rajat, what are some of the main events that our listeners should watch closely in the coming days?
Sure. The main one, of course, is tonight's U.S. non-farm payrolls data. We are speaking on Friday, so this is due in a few hours. This holds the key to determining the potential for a more protracted pullback in risk assets. The build-up to this data has been mixed, I must say. While US job openings rose more than expected and the hiring rate ticked up, the job openings rate was unchanged and the quits rate fell, which shows that job leavers are less confident in leaving their jobs. Now, alternative sources of job openings data from Indeed and LinkUp, for example, suggest a deteriorating job market. Additionally, US private sector job creation as reported by ADP, fell below estimates. So, overall, the job market continues to cool. We are looking at two key indicators very closely from this non farm payrolls data tonight. The first is the total number of hours worked, which has been on a downtrend, and the second is the rate of permanent job losers. Permanent is the key word here. We're looking for those who are not on temporary jobs who have lost their jobs, as these are early warning indicators of a sharp deterioration in the job market. Also, ISM services PMI data next week, especially the new orders component, will also provide an update on the resilience of this key economic sector for the US. Other than that, the Fed policymaker commentary, there are a lot of Fed policymakers due to speak next week, and developments on the Red Sea are likely to guide markets in terms of their implications for oil prices and inflation outlook in the near term.
Thank you for the informative sharing, Rajat. As usual, highlighting a few key takeaways for this week's podcast. The first one is definitely to trim excessive exposure to equities and to add on to DM government bonds. The second one is switching into growth stocks which have strong recurring revenue stream to weather unfavorable macro environment. Lastly, MSCI Europe continues to be attractively valued. However, in the near term, we see European equities as overbought with a significant risk of a minor pullback. That's all the time we have for this week. Thank you so much for listening from start to end. Have a wonderful weekend ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.